Talking long-term dividend and investing. When I first started this portfolio, as you can see, back in December of 2019, which is when I first started working and decided to create an M1 portfolio, you can see that the dividends were, of course, fairly small. And if you're new to investing, this is typically what you're going to be looking for, or this is typically what you're going to be looking forward to when you first start with your first portfolio, because you might not have a lot of liquidity, you might not have a lot of money that you're able to put in. But most important thing is that you're consistent with your investing, picking solid stocks, and of course, for basically looking for income. And so at the very beginning, back in December, you can see I put in a couple $100, and as you can see, the dividends were fairly small, pennies, literally pennies on the dollar. And of course, those started to creep up in January. Looking into at the end of January, you can see the dividends were still fairly small. Jumping into February, they started to get a little bit bigger, almost close to $1 on some of them. I did, of course, switch around from different stocks that I originally had. Like, for example, Triple M was one of the stocks that I had in my portfolio that I eventually I should say, moved out. CCL at one point, right before the pandemic, the stock did pay a dividend, and it paid a fairly decent dividend. Of course, now it's not paying a dividend because of the pandemic, and everything is basically on hold. And of course, going into March, February, etc., as you can see, actually I didn't receive a dollar up until March, right? So we started back in December, January, February, so it was about 4 months, just the beginning of the fourth month before I actually had my first whole dollar in terms of returns. And then it got a little bit nicer here, as you can see, pretty close to $1 for both of these back, of course, in March. And then kind of picking up a little more, we see basically now we're starting to see more dollars, $1.60, $1.34, $1.44, $5 from Iron Mountain. So that was very nice. And so as you can see, even Foot Locker, right before Foot Locker stopped paying for their dividend, and they temporarily halted their dividend, you can see that it paid a fairly nice dividend. So this is typically what you have to look forward to as a new investor. You can see it starts to scale up a little bit more. We start to see that the dividends become a little bit bigger, kind of averaging, obviously some of the stocks that are more growth stocks like Intel that do pay a dividend, the dividends are fairly small. But of course, the purpose of this portfolio is to generate income. Right? Currently, I think I am at about, I can currently see what my average, so let's take a look here. So this is my current portfolio. It's almost as accurate as I can get it. So currently we're at 1,059. And so if we were to pull up the trusty calculator, taking a look at how much are we basically generating on a monthly basis, we're currently at 1059. And of course, that's divided by 12. So if I put no money, right, if I just literally stopped today and stopped putting money, this portfolio that I have right now in terms of my dividend play is generating $88.25 of passive income, right? So every month that rolls by, on an average, I would get about $88. Of course, some more than others. I use trackyourdividends.com, which makes it fairly easy for me to basically go down to the tools here, and I can see upcoming dividends, right? So it kind of gives you the breakdown of what each month will look like. And so for the coming month of September, as you can see, we're going to get $62.48. And it also lets you know whether or not the company has confirmed a dividend or if it's currently still unconfirmed. And we see Ladder, which is a real estate stock, currently says it's going to pay $30 on September 23rd, but it's currently unconfirmed. So hopefully they will confirm that over the next week or so. And so I'll be looking forward to, for this month of September, $62.48. And of course, it'll dip down, as you can see, because it fluctuates from month to month. And you can see in November, we're looking at $93.59. And then right before the end of the year, $118 of passive income. And so that will fluctuate. Of course, this will fluctuate upwards because, of course, my goal is to continually add to the portfolio so that I can get basically the the portfolio dividend amount to, for the end of this year, we're shooting for about 20K. My goal is between 19 and 20K, and then to take this $88 to at least $100 a month for passive income. And that's basically the goal. I've got another 3 months to put in. I'm typically averaging at about 2,000, 2,500. And so for 2021, I'm looking to kick that up to about 3,000 to 3,500 with the end of 2021, where I'm investing roughly 4K a month into my portfolio. Now, of course, my portfolio a little bit more up to date for, like I said, this is the end of August, and you can see my dividends for the basically coming from June. We can see most of the dividends are well over $1. We're at $9, $3, $2, almost $2, $3, $4.60, etc. You can see even AT&T paid $13. EPD, which is an oil stock, paid almost $13. And so for the end of the month, you can see here from August, AT&T paid $13. So that's about $26 already, right? So we're just at about $26 right here. So that would be 26, 29, 30. So somewhere in the area of like $33, $34 for the month of August. And of course, we're going to be basically doubling that for the month of September, the current month that we're in. And so when you're starting off on a small account, this is basically what you have to look forward to, where these numbers, of course, will continue to increase, barring, of course, that you pay attention to the companies that you have your money into. Of course, the way I typically do it, I typically play the charts. I typically want obviously a company that's earning revenue, increasing year over year. There will be ups and downs throughout the economy. That is to be, of course, expected. But of course, I would want to see that the company is basically structuring itself for survivability and, of course, making smart business decisions. So if you were, for example, like, let's just say like one of them, let's take, let's look at some of the charts. Take a quick look at, for example, let's just look at AT&T, right? So for the life of AT&T, the reason why I kind of liked T, especially now, is if you just look at it, let's just say over the past 20 something years, from almost 93, AT&T for the most part stayed between around $20 and basically around, let's just say, $45. There was periods of time where the company was doing really well, making really smart business decisions, and then they started making some bad decisions that, of course, led for investors to basically not value the company as, of course, where it was up here in the 60s. And of course, there was, the stock market bubbles that have happened both in the 90s and then, of course, in the early 2000s that led to the 2008 crash. And then, of course, what's happening now, where the stock, of course, is back down like most stocks during the pandemic that have not yet recovered. But I do believe that AT&T will. I could see it pull back. I don't think that AT&T is going to be going anywhere. It's been around for a very long time. It's basically weathered the storms through the ups and downs and has continued, of course, to pay a dividend. Let's see, how long has AT&T? Looking at it on Seeking Alpha, we can see, let's go over here to the dividend. Thank you. And let's go dividends. And so AT&T has basically been paying dividends and growing their dividend for 25 years, roughly about 2%. And so what I pay attention to is one, of course, the payout ratio. That's very important. You don't want to have a company that's literally paying out, 70, 80, 90% of the money that they earn basically to their shareholders, because that doesn't give a lot of room for the company to then grow, right? And the company needs money to invest in itself and then to grow the business, or if it, of course, goes through, like, for example, now where the economy contracted briefly, and then, of course, the company then has to utilize most of its profits to basically give to the shareholders in a form of a dividend. So that's something that I look for. Typically want to see below 60%. I think AT&T will do well, kind of like Verizon, another company, has a little bit better, pays 51%, almost 52% of their income goes to paying the dividend, but they've only been paying that dividend for 7 years, and they've only been growing their dividend for 7 years with slightly better growth. But of course, AT&T has the history of weathering the storm that Verizon does not. And that's kind of why I like AT&T. I look at Verizon a little bit more. Verizon looks like more a company that has a little bit more growth to it. As you can see by the chart, it's basically been steadily going up, whereas AT&T has been basically ping-ponging through over the past 2 decades or longer, basically trading in a channel, right? So the way I liked it was I'll just basically trade the low end of the channel. As long as the stock, of course, is not making bad business decisions, then the stock will just keep on going to the downside, kind of like Ford, right? Ford is a good example, right? This is what I don't want my dividend charts. When I look at the company, I don't want to see this. This is not something that I want to see. This is not something that when you buy a stock or you buy a company, you don't want the chart to look like this. Because this just lets you know that while maybe they were paying a dividend, but this lets you know that the dividend is not safe. Because the market, right? People like you and me, or big time investors who are purchasing basically a portion of the business, are selling it. They're realizing this business is not worth $18, and they're just selling it down year over year over year over year over year. And of course, this is not what I want my charts to look like. I either want my charts to kind of look sideways, like Flow. Flow is a good example of a chart that pretty much trades sideways for the most part. As you can see, all the way back to about 2013, the stocks have roughly been trading in a little bit of a channel. We're at the high end of the channel. And of course, it pays a small little dividend, 3.27%. Not so bad. Of course, if you look at something, let's see, what's another one that's been growing, like BEP, right? BEP, which is an energy stock. So we see growth, right? There's a lot of room for growth in, this is, of course, for those who are interested in energy, but of course this is renewable, right? This is a renewable company, so renewable is the wave of the future. And of course they do pay a solid dividend. And looking at BEP in terms of their payout, right, that's actually pretty high. That's actually pretty, I wonder if that's actually accurate. I'd have to check on that one. But of course, as you can see, this is not, of course, sustainable, right? A company that was paying out this amount of money, and of course, excuse me, being very new, only 1 year of growth, and the growth is tiny. It's little bit of growth, 1.69%. So not even beating inflation, not even necessarily beating inflation. So when looking at this stock, you might think, well, okay, maybe we're just buying this for growth, right? Maybe you were buying this stock for growth, because for the most part, the stock was basically trading sideways from 2011 all the way to about 2019. So basically for about 18 years, for about 8 years, the stock was basically at $22 for the most part, ups and downs. But if you just basically split it right in the middle between the downs, the highs and the lows, we could roughly say about $22 for 8 years, paying a little bit of dividend, paying 36 cents, and then steadily, of course, moving that dividend up over the years, 39 cents, 45 cents, and then of course currently paying, I think, 54 cents. Is that the last one? We're back down to 43. Of course, and that's of course probably related to the pandemic, 54, and then we are at 43. And so a stock like this, you'd want to be careful of. Maybe paying attention a little bit more to the growth side, not buying perhaps at the highs. And that's basically how I play my dividends. And of course, this allows for a little bit of passive income. I subsequently then take this money that I earn from month to month to month, and I re-inject it, of course, right back into the portfolio to buy another share of whatever particular company. Maybe I'll buy another share of AT&T, or maybe I'll buy one share of Verizon, or half a share, since you can buy micro shares. And so that's basically what I utilize this portfolio up until, of course, when I decide to retire, and then I can utilize this portfolio as income. My goal, like I've previously said, my goal, of course, is to retire abroad and to utilize a portfolio of roughly around $300,000 to get around $1,500 of passive income. All right, so $1,500 of passive income from dividends roughly is about 18,000, I believe. Yeah, so 18,000 a year just in dividends. And of course, that's all while maintaining my principal, because obviously if you lose your principal, you basically can't play the game anymore. And so that's basically how I'm playing this particular portfolio. Up to this date, you can see I have earned $234.52 in dividends. And in my IRA, I also have an IRA with M1. I've currently earned $34.49. And so I have a very similar portfolio. This portfolio is also doing pretty well. We're up $305 on our $3,800 invested. I should say $3,500 invested. So that's not too bad. And that's basically a little bit of an update of what this portfolio is doing for me, how you can utilize purchasing companies that are doing very well, like for example, AT&T, real estate. These are REIT companies. I do like a little bit of oil. I do like Canadian oil. I did decide to sell. As you can see, I do have some sales going on. I finally decided to just get rid of BP and EPD. I really didn't want 3 oil stocks. And I currently am selling Netflix in favor of Apple and getting rid of Micron in favor of Square. So I have a lot of buys. I've got about 1,700 in buys going in for tomorrow. Of course, these are going to end, of course, 1,700 in sell. So we're getting rid of this and basically swapping into stocks that I feel have better growth than, of course, BP and EPD, because oil is not the future. Renewable, of course, is. And then investing a little bit more into some certain dividend. It's basically going to spread it out to my entire account the way I have allocated within my portfolio. So that's basically an update for this. What is it, September 1st already? Damn, time is flying. So if you like the content, be sure to subscribe so that you don't miss out on future videos. And of course, feel free to like, and if you have any questions, leave them in the comment section. And of course, if you're looking to make an M1 portfolio yourself, feel free, of course, to utilize my referral link that I will be noted, of course, in the description box. Thanks for watching, and I'll check you out next time.